Today's market call is presented by FactSet, financial data and analytics powered by tomorrow.
It's 8 a.m. in Los Angeles, California, but it's 11 a.m. on the East Coast. Why are you laughing at me, Dan?
What, you got LA on your brain here?
A little bit for some reason. I'm not sure why. There was an earthquake yesterday, apparently, in San Diego, and I noticed something. The elephants at the San Diego Zoo sort of made a big circle around the baby elephants. Fascinating video. Maybe we can put it in the show notes, or maybe not.
So
anyway, this is
11 a.m. here, and so what do we do at 11 a.m. here, guys?
Well, we do market call. It's you, it's Swizzle, it's the audience. By the way, if you have any questions, blow up Amanda's inbox or the chat or whatever people do in these things, because we'll effort to answer them, Dan.
Yeah, a little housekeeping really quickly. Amanda has this Fast Money Live. We did one on February 27th. It was at the NASDAQ. You kind of get there at the pre-show, pre-Fast Money. The producers, Melissa, they give you a little 411, how the sausage is made. Then you do a watch party at 5 o'clock, 6 o'clock. We do a Q&A with the whole panel. You get to ask questions. Actually, during the show, Guy Adami is going to come out into the crowd, take some questions. You might be able to ask them on air. We have a special rate that we secured. Oh, by the way, after the panel thing, after the show, we have a cocktail hour. We'll spend a lot of time, chat people up, drink some Como tequila. Amazing, amazing, amazing. So if you want to go June 5th, you want to stake, you want to buy a ticket, you want to use our special promo code, there it is on the line. Go do it. We look forward to meeting you. And Guy and I, this is not going to be around for a long time. There's not a lot of tickets left, but we're going to throw in, if anyone does it through us, you send a screenshot of your email registration to amanda@riskreversal.com. We're going to send you a bunch of swag. So that's that.
We're looking forward to it. The last one was a lot of fun. We're not going to chat you up. I don't even know what that means. We'll talk with you. We will have meaningful conversation.
Yeah.
I mean, anyway, Dan, what was happening in 1995? Do you remember by any chance? Because
I graduated college.
Yeah, I was working, obviously, because I'm old. But
You
apparently,
for like 15 years.
Apparently, the people have not been this bearish since 1995. And I got to be honest with you, throw this slide up. I don't know why. I mean, I was drinking Pepsi maybe in 1995, but I don't know exactly what was going on at the time. So it's funny how you see something like this and you try to think about, what was the prevailing winds 30 years or so ago. But with that said, I mean, people are bearish. Now, a lot of people say, okay, if everybody's bearish, it must be a counter indicator and the market's going to bounce. We're going to have some sort of V-shaped move to the upside. And that's a possibility. But just because everybody's bearish doesn't mean everybody's wrong. The same way when everybody's bullish for years and years didn't mean everybody was wrong as well and didn't necessarily suggest we're at the top. So I throw this out there just to start a conversation.
It's interesting that you start out by saying what was going on back then, because when you think about it, a lot of folks who weren't in the market, they think that, the dot-com sort of bubble was kind of like 99, 2000, and then it burst. It really started, and maybe Amanda can find out, I think it was 1994 or 5 that Netscape went public. And this was one of the first kind of shots across the bow to the investment community that there was a new technology in town, right? And it was going to be very disruptive. Now, a lot of folks weren't paying attention, but from 1995 to 1999, the S&P 500 averaged 25% returns. Just think about that. Now, there was a lot of volatility in and around that, but it's funny that happened in 95 because, again, I don't know what happened. There must have been some sort of growth fear or something like that, Guy. It wasn't a valuation thing. I can't imagine back then, but it wasn't until 1996 where Fed Chair Alan Greenspan used that expression, irrational exuberance in the stock market. So off of that low, and maybe we can get some charts going back to there, off of that low in sentiment, there must have been a big rally, which I think is getting to your point right now, that if we are at the lowest levels in 30 years, as far as bullishness, what happens next? Is that where you're going with this thing?
Yeah, a little bit, and we're going to find out. So, I guess my point is, maybe people were jumping the gun then. Obviously, they were right and probably in terms of their thesis, but their timing wasn't particularly great. And we say it all the time. In this world, if you're early, you're wrong typically. So, now you look at it and people are feeling the same way they did, again, 3 decades ago. And the next question you have to ask oneself is, are they right this time? Are they right for the right reasons? Are they looking at things? And I think I'll say this. I think the market participants in aggregate are far more well-informed now than they probably were 30 or so years ago. And I'm not trying to be derogatory in any way, but just people have access to a lot more information. So we will see. I will tell you, the market has had a nice bounce clearly. And today we're sort of hanging in there. If a man who wants to throw up an S&P chart, we're probably up 25 or so handles. And, it feels as though for the short term, at least, a lot of the pain's sort of in the rearview mirror. We have talked about this a number of times on our show and on Fast Money. This is not out of the ordinary. It probably still has maybe from here 85 to 100 S&P points room to the upside. And then we'll have another conversation. By the way, we had Cameron Dawson on yesterday, the Risk Reversal podcast, and she thought similar, that there was probably still some upside before we start to, reaccelerate or start to move back lower. So that's where we are right now. The VIX has obviously calmed down below 30, but I'm not ready to wave the all clear flag by any stretch.
It's interesting. So August 9th, 1995, Netscape went public. It traded or it priced at $28 a share. It was a nearly $2 billion valuation. It got bought by AOL. That would be the America Online for $4.2 billion in 1998. It closed in 1999. And the value of it in 99 was $10 billion by then, because AOL was one of the best performing stocks in the stock market. So a little market history there. Neither AOL or Netscape are around anymore. So interesting stuff. I mean, it's funny, Guy, going back that far and seeing a piece of data like that, I don't know if it gives it more or less importance, because how different the market structure is today, how many more different types of investors are in the market. First and foremost, algos, you know what I mean, which did not, for the most part, systematic trading didn't exist. I'm sure there was a handful of quant funds back then that were, killing it. But retail hadn't really come in the same way, right, until we had those online brokers and the like. So I don't know, generally listen, every night on Fast Money for the last, you've been doing it for 18 years, we get some data point like that, right? You know what I mean? And to parse through all of them, it gets a little tedious, but this one, maybe because it's going back 30 years, is interesting. One thing I'll just mention, I just got back from a breakfast meeting with a woman.
How was that? What'd you have?
I actually had a buttermilk biscuit, and I had one of those spindrifts, and then I had an iced coffee. It's basically, it's moving to iced coffee season now. I'm kind of moving on from the hot coffee. Today it's 64 degrees here in New York City. It feels balmy, and that was my first iced coffee, I want to say, of 2025.
Congratulations. No, it's nice. Amanda's just saying, I have iced coffee all year round.
I know she does.
I'm sure the audience is interested. She lives in North Carolina, so
a warmer climate.
I think the farther south you get, the more inclined you are to have. It gets a little humid down there.
So my friend that I just saw, she is a venture capitalist. She invests in private companies, largely tech companies. And she asked me about the public markets. And, when you have somebody investing real capital in the private markets and they're not paying attention to a whole heck of a lot in the public markets, she asked me about what's going on. What are you doing? Blah, 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 all that sort of stuff. I just think it's really interesting. Now, a lot of folks who listen and watch our shows, they're kind of locked in the markets, but most people are not. So when you see that sort of data, I just find it kind of interesting, because I was explaining to her, the last bear market that we had in 2022, the S&P had a very orderly sell-off. There was do you agree? There was not a period of panic like we just experienced, despite making a series of lower highs and lower lows. And maybe that is the sort of price action. Maybe that is the sort of crescendo that helps put in a bottom, especially when you have that bearish sentiment.
Yeah, we've talked about this, and I think I'm glad you brought it up. The only real panic I saw last year was that August 5th day. And, we've talked about that a number of different times. And the VIX suggested exactly that. There was something going on, and there was absolute panic in the market. The other times that I saw panic last year, and we've talked about this as well, although nobody will identify it that way, some of the up days we saw last year, no doubt, were panic buying. Now, the interesting thing about that comment is nobody associates panic with the upside. We've been conditioned to think that panic only happens to the downside, but I'm here to tell you it works both ways. And for every panic move to the downside last year, and maybe I know of one, maybe two, there were probably 5 or 6 to the upside. What we've recently seen, is hints of panic without question. When you see the VIX trade where it did a couple weeks, week and a half or so ago, and when you see the bond market move like it did that evening earlier last week, that was clearly panic. So we'll see. The problem is, and we've talked about this with Mandy Zhu last night on Fast Money, she thinks, and I agree with her, and I've thought this for a while, that we're in for an extended period of volatility. And, I don't think people are prepared for it necessarily because they haven't seen it or they haven't been able to deal with it for a very long time. The volatility bands have been basically short in duration, big spiky things, then we go right back down. This one's clearly lasting a lot longer. And quickly, man, if you just want to, and I'm not saying we should trade this, that's not my point, but you draw a horizontal line across those tops X August, and you'll see that all we've really, now go down, 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 all we've really done is traded back down to levels that we peaked out at over the last, year or so. Again, August 5th notwithstanding. So we're still at a heightened area of volatility, and this has lasted now for quite a period of time, Dan.
Yeah, I think that's a great point about those kind of 30 level highs or mid to high 20s as far as the VIX, because those have been good buying opportunities, right, over the last year. And the panic, to your point, was basically early August, and it was, obviously over the last couple of weeks or so. So let's see if it finds its way back to that moving average about, what is that, 17-ish or something like that. And Mandy kind of mentioned that point. The stock market doesn't have to rally a whole heck of a lot to have that thing melt into 17-ish. You know what I mean? So it'll be interesting to see. Here's some more data, Guy, in and around that same. We have two charts of the day. The first one is from Bespoke. Percentage of overbought and oversold stocks in the S&P 500 coming into today. 56.4% of stocks in the S&P remain oversold versus just 8.2 that are overbought. The 8.2 is not particularly surprising. In some ways, I'm surprised it's that high, I guess. On the oversold side, whatever, I'd love to see what sort of indicator they're kind of using, because, listen, maybe it's just a catch-all, that term oversold, but it doesn't take a genius to kind of figure that one out.
Well, I'm sure it's got to do with RSIs. I mean, when it gets below in terms of oversold, maybe below 30 or 20, whatever number they've decided, it's probably 30 or so on the downside. That's oversold condition. Maybe in terms of overbought, anything north of 70 on an RSI is, and I'm just sort of spitballing, but I'm probably close. So, or maybe it's some sort of combination of different things. But look, this is worth looking at for sure, just to sort of get the state of the market. But again, is this an indicator of a bottom and we're going to bounce in a meaningful way here? Or is just this suggesting that maybe people are starting to figure out that valuations don't make a lot of sense? And I want to give you something from Doug Cass, who, by the way, just texted me. I'm sure you have it as well. And he's talking about a lot of these strategies, and I apologize because I'm reading right now. But today, Citigroup reduced its 2025 S&P EPS from 270 to 255. And he's talking about the magnitude of the downward revision, telling you more about the forecaster and the forecaster. But this is the 17th consecutive week of lower revisions. And what he will go on to say is, again, people are ratcheting down their expectations. It makes sense. But the real question is then, what is the right multiple to place on those earnings? Again, what type of environment are we going into? So you're going to see a slowdown of earnings, which I think makes sense. But then you have to ask yourself, what is the market, and I'm air quoting, willing to pay on a multiple for U.S. companies or U.S. market that is seemingly under, there are a lot of headwinds that we're facing right now, a lot of self-induced, but a lot of just, time has a way of just bringing these conditions out. And that's going to be the rub. And I don't think people are fully aware that, multiples can trade to the mid-ish teens, 15, 16. That's not out of the realm of normalcy historically. And you start doing the back of the envelope math, and it suggests even at these levels, the market's probably still too expensive.
Right. So two things there. Yesterday, we talked about another strategist who brought their S&P 500 earnings estimate and price target down. Let's put that chart back up there for a second. So these are two separate things that Doug just mentioned to you, and I'll just, before we get to this one, because the earnings revision, this is what Doug is really getting to. So when the S&P was at 6,100, there was this 274-ish consensus for S&P 500. Now, you take the 6,100, you divide it by 274, and that gets you about 22 and a quarter or something like that, okay? We were all making the point there that if earnings estimates for the year are going to come down, right, that's way too expensive. So now here we are at 54.30. Right. And if this strategist is correct with 255, you do that math and you get 21 and a quarter. So to your point, it's still way too high, right? Like the multiple is. Now, we talked with Cameron Dawson yesterday in 2022, and we we're just talking about that bear market that was very orderly. You know, as far as the way multiples were, you know what I mean? Like the top 10 names were still really a big part of that multiple that didn't trough at like 14, 15 times, right? But most of the other 480 or something in the S&P 500 did trade down to 15. And I think 15, and Doug would know this better than us, I think 14, 15 is like usually where the market kind of troughs out at, you know what I mean, in a sustained sell-off, right? So then it brings sense, yeah. Yeah, right. And so you might not get to those levels because of the concentration in the big names. Like, you know, Apple is trading at 26 times, you know, and Microsoft is trading at 27 or so, you know what I mean? Like, so for those things to ever get down in the teens, you would have to see this chart right here just, you know, implode basically, because those stocks are going to be the ones that lead to the downside as far. But that is interesting when you think about, so you see that the revisions that happened all of 22. So we had an earnings recession there. We didn't have an economic recession. And obviously the V reversal going back to 2020 is kind of interesting because there was no visibility. You know, strategists cut their, you know, earnings estimates dramatically. And then once they saw the economy wasn't going to be shut down for that long, despite, you know, suppressed, you know, demand here and there, then it came right back. So this is important because, Guy, I don't know about you, and I the economy might have been weakening coming into this year, but again, we've used this expression over and over again. I mean, this was just an own goal. This was just the poor execution of an economic policy that is not going to actually be reflective of anything good in the near term.
You've used that expression. I've
goal. Well, what you shot yourself in the foot?
Shoot yourself in the foot. Self-inflicted wound.
Why is that better than own goal? Honestly, I don't
know, because it's a soccer term, and I loathe soccer.
Really?
I
so
just
by the way,
can't even.
So Bill,
and I'm not one to say I can't even, but it's like the guys that go to the pubs on Saturdays at like 9 a.m. and get shit-faced drunk, and with their Arsenal jerseys on. Yeah. It's really just embarrassing.
Is it?
What do you do for the rest of the day? So you watch some boring soccer game for 3 hours. It results in like a nil. Nobody scores, right? And you walk out of there at 12:15, let's say. So noon. Drunk out of your, like, what do you do the rest of the day? Do you sleep?
Unless they're Irish, unless they're watching like, you know, the Celts or something like that. They're not drunk out of their minds.
They're not. Okay, I don't know. I mean, right, like, I've seen these things.
They'll almost got a shout out.
They still sing their songs, and
it's fun.
Embarrassing yourself. Not really.
All right. So as far as that, we got really bearish sentiment. We have oversold stocks. And we have earnings revisions dropping, you know, very fast. Those aren't telling all the same story there. You know what I mean? Because at some point, I think it's probably going to be very, very hard for that 255 to bounce back towards that consensus at 274. And that's the point I would just say. If the White House and the Treasury are shooting themselves in the foot, then it's not the sort of thing that turns on a dime, right? When you think about it. So again, you know, you better get comfortable with lower earnings and maybe higher multiples. You know what I mean? Because, you know, I don't know what to tell you, Guy.
So you see, it's funny. Amanda's saying people, I'm dexing Amanda. She's saying people in the chat love soccer. Guy, you're Italian and you're hating on soccer. Clark Kemp. Yes, I am, Clark. And she's probably saying that to sort of make me lay.
That's amazing. Bill. Did you do that? What is this thing? I see it going around.
Why is there a Band-Aid there?
Yeah. Because
you got a Band-Aid, or is it a button?
A yellow card, a red card in soccer. Does that look like that? What do you do, Amanda? Do you put in like a picture of Guy and that AI generates that, or no? I mean, I saw Josh Brown post one of those.
Apparently Timmy did this. That's brilliant. Can you buy these things? Like, are they actual things? Or are they in the cloud?
Yeah.
Footballer.
Guy, this is really important.
That's not important, but this may be, yes.
So Doug just sent us this, and I love this point, and we did not thread the needle here. He goes, what makes matters worse is the sharp rise in the risk-free rate of return. That's the 10-year yield, right? And that's something that, you could have made the case that lower yields could have staved off a bit of this kind of, panic to the downside as far as selling, but they did the exact opposite. Now, we do have yields down at 4.35 or so, down from 4.6%. So it looks like for now, the fever has broken a little bit. The dollar, has rallied a little bit. I saw it above 100 before. The Dixie is now at 99.92 or something like that. So what would be the scenario that you think yields would go up? I know we have Fed Chair Powell speaking tomorrow, so that could be interesting what he has to say about inflation and what they are planned to do or not do, right, to kind of continue to work on inflation. What they might say about their other mandate is to keep full employment. You know what I mean? We haven't seen unemployment tick up too aggressively. That might, I think Cameron said this, that's maybe a Q3 thing. You know what I mean? If the economy continues to weak and we have a protracted sort of trade war. But Doug's point is that this means that the equity risk premium is getting even thinner, a negative and poor launch point at a 24-year low to future market returns.
Yeah, well, that's a great point. The different environment now, and it's different in terms of where yields are without question. And that goes to a question from Carter Evans. What's the next for the 10-year? 4 3/4. And, I think to a certain extent, you've just addressed it. They've definitely been able to stem the tide here with yields in the short term. I think a lot of people got very scared last week. And, I think, as I said, the stock market concerned people, but the bond market scared people that one evening. And the next day is when the president sort of acquiesced a little bit. And I think he did it on the back of the bond market. What were you going to say? I'm sorry.
A little bit? Question mark.
Okay, but a lot, whatever term you want. He acquiesced. I won't put a qualifier on it. And, the bond market has acted in kind since then. But for me, the wheels are sort of in motion. I mean, there's clearly something going on in the bond market, and I will continue to think that yields are going higher. But to answer Carter's question, Carter Evans, I think we go higher from here. I think this is a yield chart. If you put up a TLT chart, I think we're going to sort of cascade to the levels that we saw in October of last year, sort of this 82 or so level, which suggests, we're going to continue to sort of grind up in yields. We had that huge bounce off that, again, the recent low. But if you go back even to October of last year, Amanda, it's October of 2023, I guess. My apologies. I'm losing track of years. You'll see we traded down to, there you go. We traded down to that level. And, we bounced the first time, and then we're selling off. Next time, I don't think it holds. So we'll see. I'm still in the higher yield camp for a number of different reasons. And one of them, and as Cameron said, by the way, the conversation with Cameron will drop right after this show. So stick around and listen to that. It's a confidence game, and it's very hard for the globe or people that are buying our debt to have the confidence to do so in the environment that we find ourselves in. They will, but they will at a higher rate of interest.
So if we're going to talk confidence, and we've been mentioning this over the last couple of weeks, I don't think the Treasury Secretary, every time he goes on TV, instills much confidence. He seems to be a bit confused. That might sound condescending. You might say, who the hell are you to be saying? I'm just telling you, as an American citizen, when I see him, go on TV, I really don't get a strong sense for what he is trying to articulate about the trade war and how they might, maneuver in and around it. And, the one thing I'll say, who does inspire confidence, Guy, is Fed Chair Powell. He seems to be not willing to waver. He seems to give reasonable answers for, how they're going to basically do their best to achieve their dual mandate. I think the fact that he has stayed put on yields, I think you and I both agree, he probably panicked a little bit back in September for that cut, that they did, the 50 basis point cut. But right now, the last thing you would want him to do is acquiesce to the president, because right now they don't instill confidence. And that was reflective in the move in yields last week. So if they're focused on lowering yields, they're pressuring the Fed Chair Powell to cut interest rates, but the market's not doing what they want. Now, we have talked about this again, and Doug's talked about, like, for them to roll $9 trillion of debt this year, it could be very painful if they have to do it right at the yields in which, so that's one of the reasons why they were talking like down the 10-year. But to your point about the holders of our debt, if they're going to be sellers, right, and they know we're in a pinch, and that is their leverage right now to deal with us in a trade war, I don't think the White House and the Treasury thought that it was going to get here. And I know we're going to talk about Boeing and some of these other things. The retaliatory things that they are doing right now, whether it be in an effort, you know what I mean? Like whether it's currency, whether it's yields, whether it's, telling their airlines to stop buying Boeing planes, you know what I mean? All that sort of stuff. Like, it's not good, man. Like, we're going to have to really come to, some sort of mutual sort of agreement where we can work together, because I think the Chinese, despite their very weak economy, have some levers to pull in this negotiation.
Well, that's it. I mean, if we didn't have the debt levels that we had here in the United States, and if Japan, number one, and China, number two, weren't the two top holders of our debt, then we'd be having a different conversation in terms of who holds the cards. But the unfortunate reality is, when you have that much debt, and when one of your biggest adversaries, theoretically one of your biggest allies, but I don't know in this environment, are the two top holders, then the pendulum sort of shifts the other way, and people are forced to say, maybe we should be looking at something else in terms of, paring down our risk, and what's the sort of flight to quality trade? Because right now, it's not coming in the form of the dollar or necessarily the U.S. bond market. So that's why I think there was sort of a bit of a miscalculation on terms of who owns all the cards.
Yeah, I mean, the other way to think about this is, given all of this volatility and all these different asset classes, the S&P is only down 8%, and you think about it, the average stock in the S&P 500 is down probably a lot more than that. I think in many occasions in the mega cap tech stocks, they're down 20% plus, you know what I mean? That kind of Mag 7 or something like that. So, again, I mean, maybe this is just one of those kind of run of the mill sort of, corrections in the S&P 500. I think the reason why people were so freaked out is was self-inflicted for the most part.
We like to say own goal.
You like to say own goal. I like to say self-inflicted, or shot themselves in the foot a little bit. And the other point is like, that doesn't, again, back to the confidence, it doesn't instill confidence, because then you're just left guessing here. And I think that's where the market is right now. But, the speed in which the market sold off, the reasons for it, maybe we can find a home here. I don't know, because if you go back and you look at last summer and you look at the speed in which we sold off there, it only took about a month or so, to get back towards those prior highs. I don't think we're going to be back towards 6,100. I think it's going to take months, if not quarters, to get back there, guys.
That I agree with. I don't think, if you're looking for the similar type of move that we've seen over the years, where the market just sort of ricochets off the low, I just don't. We're just not in the environment for that to happen, in my opinion. Real quick, Michael Graham has a question around gold, but in terms of silver as well. And I'm reading, so I apologize. Thoughts on the gold-silver ratio? He bought some PSLV. I think that's a Sprott Physical Silver Trust ETF to play for a catch-up move. Listen, I do think silver is going to be in play here. I think one of the reasons silver has lagged as much as it has, because it's an industrial metal, and obviously if things are slowing down, industrial metals fall victim to that. But I do think, just in terms of the ratio, as you point out, and it's been this way for quite some time, gold's obviously trading at an all-time high, and even at $30, silver's sort of 50%-ish of its prior all-time high. So if you were to recapture even some of that, silver can play catch-up here. I don't know what the catalyst is going to be, but I like your thought. Silver, a lot of people are actually, that I speak to, are playing silver for the catch-up. And then real quick, because we have a question, I think, about Bristol Myers, if you throw that up. Thoughts on BMY here. I'll tell you, Bristol Myers is one that, if you watch Fast Money, I've talked about on and off for the last couple of years, and it's definitely had some headwinds. But if you go back and look, since last summer, this was a stock that was actually starting to perform pretty well. I think it went from sort of 38. I think it got over 62 recently, but like the rest of these names, it sort of pulled back. So I like Bristol Myers here, but the whole sector has a giant bullseye on its back, unfortunately, Dan.
Yeah, no doubt. You know, and again, I think the president said they're launching an investigation into, you know, kind of pharma and, you know, the leading towards some sort of tariff sort of thing. He's been kind of signaling that they're going to throw some tariffs on pharmaceutical and, you know, products, drugs, the whole thing. You know, again, that's a good example, like the speed in which that sold off. I mean, that has really nothing to do with that company's fundamentals. It just has to do where they sit in the supply chain and where drugs come. I want to talk quickly, Guy, about semiconductors. And I just put this article in from the information, and maybe Amanda can bring it up here. You know, we talked about it on Fast Money a little bit last night. You know, listen, there's a lot of intentions of this trade war that should be bipartisan, and we could all agree. You know, the COVID kind of laid bare our reliance on Chinese manufacturing and the supply chains and how they're oriented, you know, in and around China. And a lot of our companies here, our big tech companies, have spent decades working on this, primarily for cost purposes, right? So this is a really interesting headline to me. Jensen Huang did go to Mar-a-Lago. What, about a week ago, had dinner there. We know a lot of these other semiconductors, which basically, you know, are kind of in hock to the government because of the CHIPS Act last year. You know, they were given grants and they were given, you know, loans, like low interest loans and everything like that. If this basically can happen, if NVIDIA partnering with Taiwan Semi in Phoenix or in Dallas and Wistrom and some of these other companies like Foxconn, if they're going to start building fabs here to build chips here, that's great. But make no mistake about it, that will be very inflationary, because if the chips are the most important components, let's just say in this case GPUs, that are going into servers and the like, and listen, you're going to need GPUs that are going into PCs and the like, if you're going to have, you know, these AI powered PCs and like, if they're over here and the assembly's still over there and a bunch of the other components, it doesn't really, it's going to take years for this to work out in a way that will be something, you know what I mean, that will benefit US consumers. It might benefit some manufacturing capabilities here and you know, training. You know, it's not going to be millions. It's not going to be millions of people employed. It's going to be first tens of thousands. You know what I mean? And there's construction in around. There's a lot of stuff going on. But I just think those are interesting headlines, because what they're doing is they're just trying to, you know, just
just trying to sort of tame the lion. I mean, listen, I mean, that's exactly what's going on. And this happened in the first administration as well, when there were these all these plans. I think it was Wisconsin, right? They were going to build all these plants in Wisconsin. And listen, it makes for great headlines. And when you hear the number, $500 billion investment, you know, you get excited. And then you start to aggregate all these numbers together and you tell the American people that we have, you know, $3 trillion of investment coming. And it sounds good, but there's no real follow up there. You know, once you've made those headlines, they're you know, they basically are what they are. They're headlines, and they're used for media events. But, you know, a year later, we're going to be having the same conversation. I mean, I'm sure you will bring up, you know, where is that NVIDIA investment? Where are those dollars? And, you know, 2-3 years out, it's the headline they're looking for. The subsequent follow up or follow through, everybody seems to shrug their shoulders about. And that, by the way, go back and listen to what happened in 16, 17, when all those investments were promised in the state. I mean, in Wisconsin, that really never came to fruition, if I'm not mistaken.
No, it didn't. I mean, there were big photo ops and the like, and you know, this, you could extend this out a little bit to any sort of negotiated sort of truce in the trade war with China. Is that, you know, the Chinese back in, like, I think it was 2019, they basically said, okay, we're going to kind of operate, you know, this kind of phase in of some of the negotiated terms, right, with the tariffs and everything like that, and they just never really followed through with that sort of stuff. So maybe that's one of the things that kind of gives the Trump administration, you know, a little more pep in their step to kind of work on this in the right way. But, you know, the other thing is just in broadening out a little bit. I mean, we haven't seen anything with EU or Canada or Mexico, you know what I mean? That sort of thing. So again, you know, like China is the main event, but it just seems like that these tariffs might be sticking around longer than folks think. I want to ask you, Guy, about the stocks, the semis in general, because if you start to look at some of these names, right, that were big outperformers, let's call it 23, 24, you know, and a lot of this space started to cool out, you know, in Q4. You just see that really long consolidation there, right? And, you know, space guy is getting kind of cheap on the current year's, consensus, that sort of thing. And if you thought that maybe we're going to have a digestion phase with this generative AI trade and then things get going again, maybe later this year, early 2026, the innovation that's going on there is big. The kind of focus on now applications that are built on top of this technology. We can all agree that a lot of these models now are, essentially going to be commoditized, which a lot of folks thought. We know that the inference phase, right, for processing a lot of the queries and the like, is going to be cheaper than the training of the models. Okay. And maybe that kind of pushes adoption. We start seeing more of these applications in your everyday use on your phone, on your PC, in enterprise processes and the like. So you could say to yourself, like, let's say, we see a drop off in demand this year, but it's going to accelerate next year. And all these stocks seem kind of cheap. And even if they were to get a little bit more expensive because weaker demand, is this a space that you think could be leadership, let's say, out of whatever period that we are in right now?
You better hope so, number one, because of the size of these companies. And you bring up cheap. Cheap, as you know, is relative. And it's what I find to be peculiar is, in terms of like a name like NVIDIA, at $153, people would tell me how cheap the stock was. If you go back and remember, I mean, the whole move up, people were saying it still has room to the upside because it's so cheap on valuation. Valuation's a funny thing in this space, as you know, and you have talked about the potential for double ordering and sort of inventory builds. And if that were to happen, what looks cheap now is not going to look as cheap 6 or so months from now. So cheap in the semi space is relative, I think. But in terms of some levels, maybe we got down to it. I mean, throw up the SOX real. First of all, NVIDIA got down to where we think it should have gotten down to. That's sort of August low, number one. But, whether it's the SOX or the SMH, and we'll use the SOX and go, that's the chart. I mean, draw those lines across those right there. I mean, we actually shot through it to the downside. Those prior double tops, which were double tops until January of 2024 when the market exploded higher. Well, we went back and visited. I thought that would happen, but I thought it would happen a long time ago. We've overshot, and we're trading back up to it. Do we have a little bit of more room here? Yeah, but for the first time in a while, Dan, you can see that moving average is sloping lower. So in a space that can become highly commoditized, cheap is a relative term, which leads me to this question from one of our viewers about Micron. What do you think about Micron here? And Micron was everybody's darling. Valuation, blah, 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 until they realize, wait a second, there is no more cyclical company than Micron. And can it bounce from here? Yeah. But if things are slowing down in a meaningful way, Micron's not going to be insulated from that. So I think bounces are going to be sold here. And I think you could trade down to levels we saw a couple of years ago, which is probably, I don't know, mid-50s.
Yeah, throw Dell up here, right? So if we're talking about GPUs, we're talking about memory, we're talking about the servers, we're talking about the data centers, we're talking about the companies that are building on top of this sort of stuff. I mean, these stocks clearly overshot to the downside. If you look at from the lows in early 2023, and that's really months after ChatGPT was launched, right? And folks were really digesting what this technology sort of meant. I mean, there's no reason why Dell couldn't go back to $50. There's no reason that Micron couldn't go back to some of those early breakout levels from 2023. Microsoft has kind of been stuck in the mud, although it's outperformed. It's from a weakness standpoint, it's done better than some of the other names. I think you're going to start getting to a point where folks really start to question, who are the winners and losers, especially some of the early ones, whether they're cloud players, whether the ones who spent tens of billions of dollars, training these foundation models, and whether they have the ability to kind of, roll them out across their products and services. Microsoft is one of the ones that's clearly in question. The relationship with OpenAI right out of the gate as an investor, but then securing that technology. It seems like they're stuck in the mud. I remember going back to 2023, people were like, this is going to be great for Bing. Did you even remember that Bing, the search engine, was still a thing? Well, it's turned out to be a donut, right? And if you think about co-pilots, there hasn't been a lot of uptake. Has it been good for Azure? Yeah, because there's a lot of companies that are training, or building on top of these models and the like. And I just want to pull up Google for a second here, because this is one we've talked a lot about. And this goes back to your point, Guy, about valuation. I mean, this is one that a lot of folks had pointed to. It's like the kind of the cheaper name here. Now, did this thing get back to those August lows? Did it get back to the breakout level from early 2024, which is very near the top from late 21? And that's just technicals. Who gives a shit? The 200 days rolling over here a little bit. But this is one that should really investors should be concerned about. If you think that, the FTC, DOJ, they're all over their shit, they may want to try to break this company up. There is a total I don't want to call it headwind to their search business, right? Because of these models. And they've been working on a model. They've been working on Gemini, which really has not, has not measured up to anything else like that's out there in a way. So this one still seems vulnerable. I've kind of wanted to take an interest in this one and see how they roll Gemini out across all their products and services. I've been paying for Gemini Pro or Plus or whatever it is, $20 a month. It sucks. Like, it's just not nearly as good as when I go to Perplexity. And the only reason I go to Google now, is just saying this to Amanda, is because I still use their browser, which is Chrome. The day that Perplexity comes out with a browser, and they will come out with a browser, I think Google's going to have a really hard time, especially if OpenAI does the same thing. Guy, are you there? Are you in the same mindset about these chatbots?
Well, my chatbot of choice, I don't even want to share it because I sort of discovered it on my own. I don't want people to glom on. But what I do want people to see is this. This is just amazing.
Holy shit.
Tesla, bro.
All right, let's
What are those things below Elon Musk? What is that stuff?
AirPods.
Q-tips? They're what?
AirPods. I have the AirPod Pros. And then what is that all the way on the bottom? Who is that? And what is that white thing? I don't even get that.
Looks like one of the Cuomo brothers.
Really? That really does look like me, by the way. And I mean, I don't know. I don't wear suits particularly. I only have I have one suit, by the way. Do you know that? I have one suit. So it's something I will wear to a bar mitzvah.
It's like Russell Crowe in Beautiful Mind.
He only had one suit?
That looks, I'll tell you, that one of you looks more like you than that. The one of me looks like my fucking grandfather. Anyway, I know we got to.
What is this thing? Amanda, will you just put it in the chat? Like, I saw these things going around the internet.
Oh, my grandfather, both of them are dead, in case anybody cares.
And also I'd like to know who that little guy is on the bottom, and then what that white thing is right under the Q-tips. That's pretty cool, though. If I could buy one of those, I kind of would. I don't know if that's possible, but I think
get a two-pack.
All right, call of the day, Guy, before we get out of here. I know we want to get out by quarter of. This one's interesting. These staples, and we talked about it yesterday. Yesterday, when the market tried to rally, based on, some of the kind of rollback, or at least the push out of some of those Apple and, like some of the tech tariffs in general, you saw an S&P that was up, you saw NASDAQ was up, you saw yields down, you saw dollar down, you saw gold kind of flattish, but you also saw utilities, staples, and telcos. They were actually outperforming the S&P 500 towards the end of the day. So a stock like Pepsi is interesting to me. We know that they have some headwinds with this GLP-1 stuff, and I don't know if that's real or not. But what's your take here on a downgrade? This is coming from BOFA. That would be the
long time coming. Pump a long-term chart. I mean, this stock made its all-time high in 2023, and it's been miserable. And I'm choosing that word ever since. I mean, there's really been no meaningful bounces. And here you're looking at levels, and we're pushing towards levels we've seen in 2021, and the headwinds are there. I mean, it's a consumer headwind. You mentioned GLP-1 headwind. It's probably their inability to pass on costs to their consumer headwind. I mean, just a lot of things working against Pepsi. Obviously, they're big in the snacks thing. That doesn't seem to work in today's environment. So, I mean, I think there's the old saying, it's better late than never. So good for them. But this has been a long time coming, and I'm sure they sort of grit their teeth with this one in the same way, by the way, Deutsche Bank probably did with GM yesterday in terms of their downgrade. But I think they finally sort of succumbed to the underperformance of the stock. So it's late in coming, but it doesn't mean they're wrong.
Yeah, I mean, you and I are not looking to kind of buy staples here. Like, I don't find it particularly interesting. I think the most interesting thing, again, was that price action yesterday think Cameron called it the mullet trade, like the barbell trade, you know what I mean? Which, at some point, we saw this actually go to a 1 year on this one, and you and I were talking about this, folks were kind of saying, well, if Mag 7's selling off, but there's been, financials or these other sectors like have done particularly well, or and our point was like, well, you put all those together, whether it's energy, whether it's, you put them together and they don't equal, like a handful of them don't equal mega cap tech, right? So, what we saw though last week or a week and a half ago is like correlations went to 1, like everything went down, you know what I mean? And we saw crypto go down. We saw just a lot of stuff together, saw defensive stocks go down. So I also think, again, look at these telcos, they're up again. I think utilities are up again. Staples, if it wasn't for Pepsi, would probably be up again. So I don't know, man. Like maybe there's continues to be headwinds. The flip side of that is Coke acts very well. I mean, Coke is within a whisper or whisker of its 52-week highs. Whisker?
Either or, but we got to bounce here, Dan. Amanda's yelling at me because I did not stay true to our time cues. So
why?
I think
get out.
We were supposed to be out like a minute ago.
Oh, I think we're okay.
Well, we should pay it to Amanda's running the show. I mean, she's driving the train.
Well, you and I got off the rails a little bit on a couple instances.
That's always my fault.
All right, let's thank Doug Cass as always from Seabreeze Street Pro. He is a great contributor to what we do, and we really appreciate his support. We got to thank the audience and all the questions that we try to get to. We have to thank whoever is the image generator, for those little fancy things. Guy Adami, the footballer, and Dan Nathan, the Tesla bro. I love it. We good? We out?
So good. We are. We'll be back tomorrow, though, without question. As you know, if it's Wednesdays, it's Butters. Dan, yes?
Bitch.
See you later, folks.